Hello everyone, this is Sunko, the Korean bro. Today is August 24th, and let's start reading stock market. Okay. Hmm. Okay, what do we have? Nvidia stock pops after another blowout earnings. Just how high can this all high? The pattern whoosh continue as this stock hits a new all-time low. Can the stock ever rebound? Nvidia just announced a strategy partnership with a private AI foundation. Is there a better AI stock to own right now? Hmm. Password crackdown is fueling strong Netflix subscribers growth according to new data. Okay, let's see. A bull market. Rise stock. Nvidia's massive news for Nicholas investors. Mm, okay. First, Nvidia reported quarter-second revenue and earnings that trounced Wall Street expectations. The chip maker looks for revenue to soar to $16 billion in quarter third. Nvidia stock could fly a lot higher, but changing competitive dynamics and a premium valuation could be key obstacles. Massive AI tailwinds continue to power Nvidia's staggering revenue growth. 3 months ago, Nvidia delivered what one analyst called guidance for the ages. The graphics processing unit maker projected that its second quarter revenue would be in the ballpark of $11 billion. Nvidia faced lofty expectations as the company reported its quarter second results after the market closed on Wednesday, and it didn't disappoint. The stock popped after another blowout earnings report, jumping nearly 10% in after hours trading. Just how high can this all stock star fly? It turns out that Nvidia's management sandbagged what its guidance for it. Instead of reporting around $11 billion in quarter second revenue, the company actually posted revenue of $13.5 billion. The total more than doubled Nvidia's revenue generated in the prior year period. Hmm. The race is on. Nvidia founder and CEO Jensen Huang proclaimed a new computing era has begun. He said that companies across the world are moving from a general purpose computing to generative artificial intelligence and accelerated computing. Huang added, the race is on to adopt generative AI. Speaking of racing, Nvidia's revenue appears to be on track to pick up momentum. The company expects third quarter revenue will be close to $16 billion. That's 27% higher than the consensus Wall Street estimate prior to Nvidia's quarter second update. It even topped the most optimistic estimate among the 33 analysts surveyed by Refinitiv of nearly $15.2 billion. Nvidia isn't resting on its laurels. The company has already announced several new products that are either already available in quarter third or soon will be. Hmm. They include the L4OS GPU that can be used in AI servers and Spectrum X, which helps boost the performance of AI clouds. How high can Nvidia fly? Before Nvidia's quarter second update, Wall Street consensus 12-month price target for the stock reflected on upside potential of a little over 11%, but Nvidia's share price nearly reached the existing average price target and after hours trading. The company's impressive results and optimistic outlook will almost certainly cause some analysts to up their targets. Hmm. While Nvidia is likely to continue to dominate the market, these competing efforts could impact the current dynamics. They're creating such a massive tailwind for the company. There is also that pesky detail of Nvidia's valuation. The stock already traded at 19 times projected 2025 sales before the quarter second update. I bet much of Nvidia's growth is already baked into the price. At worst, its price is well ahead of the company's realistic growth prospects. Okay. The pattern wolves continue as its stock hits a new all-time low. Can the stock ever rebound? Palantir just released its financial results for the fiscal 2023 fourth quarter and full year. The company suffered a drop in subscribers in quarter fourth. They issued a weak revenue forecast for the upcoming quarter. Mountain will face mounting questions about its ability to survive if it can't find a way to return to growth soon. Paladin's turnaround story just hit several speed bumps. It feels like an age since pandemic-related lockdowns and social restrictions were lifted. And for Paladin Interactive, they marked the end of the boom in its business. The maker of at-home exercise equipment was one of the greatest growth stories of 2020 and 2021, as it gave consumers an outlet during a time when gyms were closed. The opportunities for physical activity were few and far between. But with conditions now mostly back to normal, Pound has been grappling with collapsing sales and steep financial losses. The company just reported its financial results for the fiscal 2023 full year. While there were apparent improvements thanks to its new CEO, who joined in 2022, the company is clearly still fighting for survival. Poundage stock plunged 22% to a new all-time low following the release of the fiscal 2023 report. It's now down 96% from its all-time high. Will a comeback ever be in the cards? Let's explore what the company needs to do. Okay, Palantir's new CEO is racing to transform its business. Okay, but Barry McCarthy joined Palantir as CEO a little over halfway through its fiscal 2022 year. He brought an impressive amount of experience to the company, having spent over 20 years in senior roles at Spotify and Netflix. He was a fan of Palantir's products, which now include a digitally enabled exercise bike, rowing machine, treadmill, and a host of virtual classes and content to go with him. He needed to hit the ground running because after Pound delivered surging growth in fiscal years 2020 and 2021, it adjusted its cost structure for further expansion, which unfortunately wasn't materializing. By the end of fiscal 2022, Pound's revenue has shrunk 10% compared to fiscal 2021, while its operating costs more than doubled. That resulted in a whopping $2.8 billion net loss for the year. The company didn't have enough cash in hand to endure more of the same in fiscal 2023. McCarthy immediately began slashing expenses. He cut Pound's workforce by more than half, closed its in-house manufacturing operations in favor of offshoring, and slashed marketing costs. To compensate for the lower advertising spend, Pound began selling products through third parties like Amazon and Dick's Sporting Goods, whereas it previously only sold through its own retail channels. The company also began selling its equipment on a subscription basis. Given that its products are quite expensive, the bike retails for $2,495, it wanted to reduce the upfront cost burden on new customers by allowing them to pay per month. So far, about 48,000 customers have taken up the offer, which isn't a big number, given the Pound has over 3 million connected fitness subscribers overall, but the offer is still in its early days. Overall, the McCarthy-led initiative has succeeded in stabilizing Pound's financial position, while fiscal 2023 revenue shrank by another 21% compared to fiscal 2022. Its net loss narrowed by more than half to $1.2 billion. Now the company wants to return its revenue to growth over the next 12 months and consistently achieve cash flow break-even. A series of speed bumps might stand in the way. While Palantir has made positive progress over the last 12 months, the path forward is plagued with uncertainty. In May, the company announced a voluntary recall for its byproducts sold between January 2018 and May 2023. Over 2.1 million units are eligible for a new seat post, which poses a small risk of wreckage. It's having a twofold effect on the company right now. First, sales of new bikes are constrained by shortages of new seat posts, which are instead going toward fulfilling recalls. Second, it has received over 750,000 recall requests so far, more than anticipated, costing Pound $40 million to date, and the number is expected to rise. unexpected. A drop in connected fitness subscriptions orders hurt Pound in the fiscal 2023 fourth quarter. The company lost 29,000 members on a net basis as hardware sales slowed due to seasonal factors affecting the acquisition of new customers. Unfortunately, Pound expects that seasonal weakness to continue and issued a very weak guidance for the fiscal 2024 first quarter, which points to a sequential revenue drop of as much as 9.6%. In an economic environment plagued by high inflation and rising interest rates, consumers typically spend more money cautiously. Spending thousands of dollars on at-home exercise equipment might not fit the profile, especially with so many other options available for physical activity. Okay, Pound's fight for survival isn't over just yet. Pound currently has just $813 million in cash and equivalents on its balance sheet, which isn't much to work with considering the scope of the task at hand and the size of its net losses. It needs to generate more revenue, otherwise, it will be forced to cut costs further, potentially resulting in a further slowdown in sales and a proverbial death spiral for its business. Given the slowdown in hardware sales, Payoneer is trying to increase the addressable market to include fitness enthusiasts who don't want to own its equipment products at all. In May, it launched three new subscription tiers for its mobile application, all offering users access to Pound Gym. It provides unique workout plans and challenges to help users on their fitness journeys, from running to weight training and everything in between. While this initiative was off to a hot start, subscription fell 16% in quarter four, and Pound's guidance suggests another 10% drop compared to the quarter four number in the upcoming quarter. Circling back to the original question I posted at the top of the piece, I personally don't think Pound stock will ever return to its all-time high of $662, which valued the company north of $50 billion. Despite recent progress, the 96% plunge in value since then is warranted because there is still a question as to whether Pound will survive. Until that is answered, most investors will likely view the stock as far too risky to own. Password crackdown is fueling strong Netflix subscribers growth according to new data. Password crackdown is fueling strong Netflix subscribers growth. Okay, faced with slowing subscriber growth, Netflix introduced paid account sharing and ad-supported subscription tiers. The initial results last quarter showed that these measures significantly boosted growth. The streaming pioneer continues to reap the benefits of its strategy shift according to new third-party data. Okay, a lot has changed about Netflix over the years. In the early days of streaming, users were encouraged to share their love and their password, and the hopes of drumming up additional interest in the service. In 2017, Netflix posted on X, "Love is sharing a password." The company is no longer feeling that love. Earlier this year, in the face of high penetration and slowing growth, Netflix had a change of heart. The company notified members that the service was only for usual members in their immediate household, introduced paid sharing plans which allowed subscribers to add people outside their household to their account for $7.99 per month. While there was the usual wailing and gnashing of teeth from users, the plan was wildly successful. Netflix had its greatest screen time subscriber spike in years, and new data suggests that there is more to come. A brilliant strategy. Well, investors were okay concerned that Netflix password sharing crackdown could backfire, weighing on subscriber growth, but it turned out those fears were unfounded. In the first quarter, which has been historically slow, Netflix added nearly 6.6 million new subscribers, its biggest quarter's first gains in 3 years. This management credited its strong performance to the launch of paid sharing across 80% of our revenue base. The company noted that new subscribers already exceeded the cancellations from customers protesting the move. Now, the shareholder letter held more good news. We expect revenue growth to accelerate in the second half of 2023 as we start to see the full benefits of paid sharing plus continued steady growth in our ad-supported plan. Based on recent third-party data, this company strategy is still paying dividends. Millions of new subscribers. After strong subscriber additions in June, the trend continued in July, albeit at a slower pace. Netflix added more than 2.6 million new gross additions in US last month, according to a report released by market data provider Antenna that compares nearly 3.5 million in June. Re-energizing Netflix's growth. Okay, to be clear, Netflix isn't the streaming buy it was a year ago. The stock is currently selling for roughly 5 times next year's sales. The said management has outlined a clear path to continuing growth, and given its scale and leverage, each new subscriber will add to the company's growing bottom line. Okay, let's first look at we got C Limited and Upstart Holdings here. Wall Street is currently divided on whether or not a new bull market has actually begun. Nevertheless, the street is bullish on some stocks regardless of where broader market is trading. Hmm. Shares of C Limited and Upstart could be pushed to more than double based on analyst estimate. Stock has sent investors on a roller coaster ride since listing publicly in 2020. It hit the market price at $20 per share, then surged to an all-time high of $41 before plunging 92% to about $33, where it trades today. Well, the company has developed an artificial intelligence powered algorithm designed to assess the creditworthiness of potential borrowers. Well, which he says is more accurate than fair exact traditional FICO scoring system. It analyzes 1,600 data points compared to FICO's 5 core metrics. And thanks to AI, it delivers instant automatic loan approval 87% of the time. That's a major time and money saver compared to manual human driven loan processes. They were uncertain of the algorithm's ability to account for the difficult economic conditions. So they were purchasing fewer of the loans Upstart was originating. Consumer demand for credit was plunging at the very same time, dealing the company a one-two punch, and ultimately causing its revenue growth to stall. Since then, Upstart has published troves of data showing its loan performance is still incredibly strong, and demand has started to return. It may appear funding partners committed $4 billion in liquidity to ensure Upstart remains well funded to continue originating launch. Plus, in quarter second, it processed 30% more personal unsecured loans than it did in quarter first, so consumer demand is also coming back. The result led to Upstart's first sequential revenue growth in more than a year last quarter, which is another sign the worst of this challenging period might be over. Hmm. Auto loans, business loans, mortgage. Over the long term, the company is eyeing a total addressable opportunity worth $4 trillion per year across personal loans, auto loans, business loans, mortgages. Now that its AI algorithm has proven its worth in one of the toughest credit environments in recent memory, Upstart can shift its focus back to growing its business. Hmm. Okay, this is it for today, and see you tomorrow. Okay, bye bye, everybody.